Welcome to The Explainer. Today, we are tackling the beating heart of global finance, the foreign exchange market. Now, you probably already know the market exists, but today we're stripping away all that complex jargon. We're going to deliver a really clear, structured roadmap of the exact mechanics behind how online currency trading actually works. Let's get right into it.
$6 trillion. That is the staggering daily trading volume of this market. I mean, to put that into perspective, this isn't just a big market. It's literally the largest financial market in the entire world. It completely dwarfs the stock market. Every single day, massive financial institutions, corporations, and regular retail traders are moving $6 trillion across the globe. But what exactly are they trading?
Okay, let's dive into this. Forex is quite simply the global marketplace where you exchange one country's currency for another. But what's really interesting here is that it's essentially an invisible product. You aren't buying a stock, or a physical item you can hold in your hand. Instead, you're basically betting on the relative strength of entire economies. If you think the US dollar is going to get stronger compared to the euro, well, you buy dollars and you sell euros. If your prediction's right, you profit. But if you're wrong, you lose. It's a direct bet on global economic shifts.
Section 1. The Mechanics of Forex. Understanding the language of the market.
So currencies are never traded in isolation. They always work in pairs, kind of acting like a giant seesaw. Take EUR/USD, for example. The first currency, the euro in this case, is called the base currency. The second, the US dollar, is the quote currency. And this brilliantly illustrates how the whole thing works. When you place a trade, you are simultaneously buying the base and selling the quote, or vice versa, all based on your predictions. If you think the base will go up in value against the quote, you buy. If you think it'll drop, you sell. It's just a constant balancing act between two nations' money.
All right, next up we have the pip. A pip is a tiny unit of price movement, usually equal to 0.0001. Now, looking at that decimal, it sounds microscopically small, right? Like, why would anyone care about 1/10,000th of a cent? Well, because when you're trading the massive amounts of money typical in this market, these tiny fractional movements add up incredibly fast. Which brings us directly to exactly how traders control such large amounts of money: leverage. This is the mechanic that makes Forex both highly fascinating and uniquely dangerous. It basically allows you to control a much larger position than the money you actually have in your account. So, for example, with a 1-to-100 leverage ratio, you can control $100,000 of currency with just $1,000 of your own capital. I mean, it sounds absolutely amazing, right? A way to maximize those tiny pip movements into massive gains.
But here's the catch. Leverage works both ways. I really cannot emphasize this enough. It is a double-edged sword of the absolute sharpest variety. Yes, it ruthlessly amplifies your gains when the market moves in your favor, but if the market turns against you, it equally and ruthlessly amplifies your losses. A tiny pip movement in the wrong direction, magnified by leverage, can literally wipe out your initial capital in the blink of an eye. So, handle it with care, unless your goal is to spontaneously fund a broker's new yacht.
Before we move on to strategy, let's cover one last piece of the mechanical puzzle here: bid versus ask. Every currency has a bid price, which is what buyers are willing to offer, and an ask price, which is what sellers are demanding. The gap between these two numbers is known as the spread. And this spread is the primary way that brokers make their money off your trades. It's essentially the transaction fee just baked directly into the price of the currency pair.
Section 2. Your first 5 steps. How to start trading safely.
All right, here is the exact path you need to follow. Step 1. Choose a regulated broker. This is absolutely crucial. Ensure they're regulated by top-tier organizations like the FCA or ASIC. Never, ever use unregulated brokers. Step 2 is opening an account. Step 3 is funding that account, starting very small, maybe $100 to $500. Only risk what you can afford to lose. Step 4, you're going to download an industry-standard platform like MetaTrader 4 or 5. And Step 5 is learning to read the charts. But listen closely to this pro tip. Before you ever risk a single penny of your hard-earned cash, spend at least 2 to 4 weeks practicing on a fake money demo account. Seriously, blow up fake money first so you don't blow up your actual savings.
And when you're practicing, definitely stick to the major currency pairs: the euro and US dollar, the British pound and US dollar, or the US dollar and Japanese yen. Now, why these specific pairs? Well, because they're the most heavily traded pairs in the world. This means they feature tighter spreads and much more predictable liquidity, which just makes them strategically sound starting points for newcomers to navigate.
Section 3. The reality of the risks. Protecting your capital.
So the crucial point is, and here is the stark reality,
Most retail traders lose money. I want to firmly anchor your expectations right here, right now. This isn't some magical get-rich-quick money machine. It's a highly competitive, unforgiving market where the vast majority of individuals end up walking away with less than they started.
But why exactly do they lose? Honestly, it's a predictable cocktail of psychological and strategic failures. They dive in without a concrete trading plan. They have absolutely no proper risk management in place. They let emotions take the wheel, making impulsive, panicked decisions. They get greedy and use way too much leverage entirely too soon. And most fundamentally, they just don't take the time to learn the skill. These are the exact traps that destroy novice accounts every single day. You need to recognize these failures so you don't repeat them.
To survive in this market, you must command your trading with strict, non-negotiable rules. You must have a concrete trading plan before you even think about entering a trade. You should really only ever risk 1 to 2% of your total account on any single trade. You must always, without exception, use stop losses to automatically cut your losses if the market turns. You never trade with money you need for bills or emergencies. In short, you must treat this exactly like a business, not a late-night spin at the casino.
Which leads us to our final thought for this explainer. Trading is a skill that takes time, patience, and serious education. Are you willing to put in the work? Forex is a fascinating $6 trillion puzzle, but it demands respect and rigorous discipline. Take a moment to deeply consider these realities before you make your next move. Thank you for learning with me today. Stay focused, and I'll catch you in the next explainer.